Hey traders, Nick here, addressing the topic of selling covered calls. This is a evergreen video, so nothing here is actually specific to one scenario at any particular time. Doing this so it'll be applicable as a concept at any point in time. I am going to, however, use actual tickers and levels because that's the only way we can make it tangible. So I'm going to say a few things about selling covered calls in general, and then share two examples where one, there isn't the possibility of doing it, and the other one there is, but with a caveat. So first of all, I can tell you right off the bat, everyone should consider selling covered calls because you have an asset, you can put it to work. Why wouldn't you? However, there are some people, some investors that should never sell a covered call because they just cannot part with their tickers. This could be emotional, this could be an actual tax situation. So I'm not a tax expert. Please consult a tax expert to see how it impacts you selling a call. Now, I can sell a covered call if I own something. In this case, if I owned 100 shares of a ticker that has options, I can sell a call against my shares. If I don't own shares, but I do own calls out in time, I can sell calls against those calls that I already own shorter in time. The level at which I can sell them can vary, and there are several rules that depend on the personality and the level of risk tolerance that you should follow. I'm going to share very simple basic scenarios here. Someone owns shares out in time, and they are down on their luck and they want to see if they can sell a covered call. Now, if I buy shares personally in a stock, I immediately consider selling covered calls. Then it's a perfect scenario. Why? I buy shares at $10. I'm okay selling them at 12. I sell a call at 12 out in time. And what happens? If time ticks and the price is still below 12, I keep my shares. I made money. It's basically creating dividends. How does that work? Let's say I own shares of this company and I bought them at 10 and I'm okay selling them at 14. So I go out in time, I find a call for $14 at the $14 level and I sell it, an option. It's a call option. I sell it against my 100 shares. Let's say they pay me $100 for it. That $100 is mine, against the promise that I will give them my shares at 14 should they ask me. That's my covered call. It's a promise to deliver my own shares at a higher level, hopefully. So worst case scenario, if the stock rallies, in that scenario, if the stock takes off and it goes to 15, and I may wake up one day without my shares. The person who bought the call from me will say, give me my shares. The shares will go away without my permission because I already gave them my permission. And whoop, my shares are gone. In place would be what? Nothing. I kept my $100, so I basically stopped being long at 15 because I gave them at 14 and they gave me $1 for it per contract, so it's $100. So the worst case scenario is a win. I capped my win at 15. That's the downside, but I can turn around and buy more shares, right? So that is the commitment of selling a covered call. I would never sell a covered call usually if it creates a loss. What does that mean? Let's say I didn't buy the shares at 10 and I bought them at 16. I tend to not sell a $14 call because then I may be forced to book a loss because I paid 16 and I have to deliver them at 14. I'm losing $2, but not really $1 because I got paid $1 for it. You follow the logic? So I own shares. I want to put them to work by promising someone that I will give them my shares at a certain price. Hopefully, it's above me. All right, so let's talk about this. Never sell a call that I can't honor. If I cannot deliver my shares emotionally or for tax reasons, I shouldn't sell that call. It's going to create issues. Avoid selling covered calls that result in booking losses. That scenario where if I bought them at 16, I'm not going to sell a 14 call. Because then if I get called away from my shares, if they take my shares at 14, I bought them at 16. That creates a loss. I try not to do that, okay? So let's say everything fits and I'm okay selling a call. Then it becomes, how do I do it? So you have to pick the right time, how far out in time. That depends. And the right level. So let's talk about the time element. The time depends on how long do I intend on keeping those shares. I know people that buy stocks for 10 years, and therefore I can go out in time as far as I want. Usually I want to go as short as possible to have the opportunity for them to expire worthless. So let's talk about that part. So in this scenario, if I bought shares at 10 and I sold the covered call at 14, and time passes and they don't take my shares away because price did not go above 14, then that call I sold dies in my favor, worthless. They bought it, they didn't exercise their right, they lost their money. I kept the money they gave me. I can repeat the process out in time at a different level. I can repeat the process again and again if they keep dying in my favor, so people don't take my shares. That's why if I own shares for 3 or 4 years, I would want to sell one every couple of months maybe. Depends on how active I am, and have it die in my favor. You have to pay attention around earnings as well because there are spikes and things. So time depends on how long I intend on holding the stock. The appropriate level, I already discussed it. If I bought the shares at 16, I'm not going to sell a 14 call. I want to see if I can find an 18 call or a 20 call or a 19 call or even just a 16 call, because that would also bring profits. So that's the tricky part. But the trickier part is knowing if it's appropriate for me to sell. And sometimes there isn't one. And I'll discuss the two scenarios today. One there is and one there isn't. So, and by the way, I don't defend them. Let's say I bought the shares at 10, I sold the call at 14, and the price goes to 15, and suddenly the call I sold is now losing me money on paper. But the idea was that I'm okay selling my shares, therefore those losses will disappear as soon as they take my shares. I'm not going to incur any losses from that sold call. The only thing is that I may lose my shares. Some people say, oh my gosh, I'm losing money, I need to defend it, and they buy it back. They buy that call that they sold back for a lot more than what they sold it for. So in essence, if you defend it, you are saying, I would rather book a loss to avoid booking a profit. And to me, that is crazy. So I just don't do it. If I sold a call, I honor it. That's why I say, never sell a covered call that I cannot honor. If I sold a call and they want to take my shares, I'm not going to book a loss on that sold call in order to keep my shares. Take them and keep my profits. That's crazy that people actually defend them. But that's probably because they didn't follow the other rule where if you don't intend on selling the shares, don't sell a covered call, that type of deal. So this is a quick look on the rules for my rules, suggestions on selling a covered call against an asset. Everything I said here works against me not owning shares, but rather owning calls out in the future. I can sell calls closer in time. Okay, having said that, let's consider the two examples here. I'm going to go with Lucid. This is a real scenario from today. It doesn't matter when today is. It's not today when you're watching this video, I guarantee you, because I'm not going to release it for a few days. So Lucid is currently at $10. Unfortunately, the person that was asking had gotten into Lucid at 33 up here. So I went through the Lucid options chain and I could not find any appropriate call to sell. I even went out to January of 2025. I could not find any premium worth selling around $33 or even at $30. So this is a situation where it is too late for me to sell a covered call against Lucid if I bought the shares at 33. That's the important. If I bought the shares up here, I could not find a call I can sell that follows my rules of what? Booking losses. What does that mean? So if I sell an $18 call and the stock rallies through 18 and they call me away from my shares, meaning they take my shares, now I booked a 18 minus $33 loss minus a little bit of the premium. So it's not an ideal situation. That would force me to book a loss. Not what I want. I even went out to 2025. Okay, so this is a this is a no covered call is recommended situation. So the second scenario is a stock called Cassava. The ticker is Sava. Again, this is not a recommendation on this one to anyone. I'm using this as an example of selling covered calls. This scenario, let's assume that someone had bought the shares at $57. Clearly, they are down on their luck, but not as much as the other one. So in this case, I did find a call level that I could sell out in time that would promise me away from my shares. I'll give you an example. So if I'm willing to own the shares for the next 6 months, actually 4 months, I could sell a $60 calls for $1.50. So in this case, let's say I own 500 shares, I can make $600-ish, give or take, depends on what it fills at, in 3 or 4 months while I'm waiting. So obviously that is not going to be erasing all my losses from 57 down to 33, but it gives me $1.50 of that. So let's say 3 months pass and the stock is still below 60. I have lowered my entry cost by the amount I collected because I just made money out of thin air from my asset that is losing money. I can repeat the process and repeat the process while I wait holding the shares. Again, this is all assuming I want to own the shares for a long time. If I don't, then I should just consider, other methods of reducing the losses. But this is at least has an opportunity. The owner of those shares can decide, okay, I'm committed for 2 or 3 years. Why don't I want to make $600 between now and 3 or 4 months out of my 500 shares that I own? You see the difference? The other one, there was no option without booking a loss. This one, if I get called away at 60, I made money because I bought the shares at 57. And I also collected $1.50 per share to sell those calls. So that's not bad. I went from losing to winning a little bit. But if I just want to minimize the loss I have selling the covered call, my expectation is that the stock is not going to do that. Therefore, I would get to do this 2 or 3 times while I wait for the years to unfold and the stock to pay me. So these are 2 scenarios of covered calls, not specific trade alerts, just the concept. So I would encourage you to stop the video here and rewind and listen to the rules of selling a covered call now that we talked about it. I bet you missed a few things. So go back and listen to those rules a couple of times. I promise you they will sink in better. And these are just my rules. Other people have different rules, but see which one makes more logic to you.